Hey everyone, welcome to today's Explainer. If you've been watching the tickers lately, you know we're seeing some absolutely massive, historic, record highs across global markets. But behind all those flashing green numbers on your screen, well, there are some incredibly fascinating and sometimes completely contradictory underlying stories. So today, we're going to dive into the data together and unpack exactly what is driving the global markets right now.
Okay, here's our roadmap for this explainer. First, record highs on Wall Street. 2, the AI and tech engine. 3, geopolitics and plunging oil. 4, India, earnings versus auction chaos. And finally, number 5, the billionaire tax loophole. Let's get right into it.
Section 1. Record highs on Wall Street. Okay, let's dive into this and just take a look at the sheer scale of the euphoric rally we're currently witnessing. To put this into perspective, the Dow Jones Industrial Average just jumped a staggering 994 points in a single session. I mean, wow. Simultaneously, the S&P 500 pushed up almost 2% to hit a fresh, incredible all-time high of around 7,745. And the Nasdaq, it followed suit, surging over 2.5%. We're literally seeing back-to-back record closes. Now, this momentum isn't just random market noise. It's being powered by three very distinct, interconnected engines: an ongoing resilience in the tech and AI sectors, a sudden and dramatic plunge in global oil prices, and incredibly robust corporate earnings coming in from all across the globe. Let's unpack exactly how these pieces fit together. Moving right along to Section 2, the AI and tech engine. Let's start with the technology sector, which absolutely continues to be the massive catalyst pulling these markets upward. But the way AI is impacting different companies is actually surprisingly varied. Now, what's really interesting about this is we're looking at a tale of two very different tech giants navigating the AI boom. On one hand, you have Palantir. They just reported an absolute blowout quarter. Commercial sales rose 149% from a year prior, driven by what their CEO actually called otherworldly demand for their AI software. Their stock absolutely skyrocketed, up 30%. But on the flip side, we have SpaceX. Despite beating their revenue expectations, their stock is actually down roughly 40% from its all-time highs. Why? Well, because the sheer scale of their artificial intelligence capital expenditures, we're talking massive infrastructure spending, is making investors pretty nervous. And that's combined with the pressure of employee stock lockup periods expiring. It just goes to show that while AI is a massive driver, the infrastructure costs are intensely capital heavy. But hey, it's not just pure tech making waves. Take a look at home goods retailer Wayfair. In a market where existing home sales have been relatively flat, and let's face it, nobody's really moving right now, Wayfair just saw its stock surge over 30%. They reported U.S. revenue growth of nearly 9%. That is their absolute highest clip in the post-COVID period. So how are they defying gravity in a sluggish housing market? It all comes down to company-specific self-help measures. They're gaining serious market share through their Wayfair Rewards program, which is successfully driving customer shopping frequency from just under 2 times a year to 3 times a year. On top of that, they're aggressively expanding physical brick-and-mortar stores in places like Chicago and Atlanta, bringing in totally new customers. And finally, their luxury brand Paragold is seeing momentum north of 30%. The big takeaway for us here: highly targeted, company-specific strategies can completely beat a flat macroeconomic environment. That brings us to Section 3, geopolitics and plunging oil. Speaking of the macro environment, let's shift focus and look at how Middle Eastern geopolitics are creating massive ripples in the energy markets. Recently, the market was entirely captivated by comments coming out of the U.S. government regarding the Strait of Hormuz. U.S. Treasury Secretary Scott Bessent explicitly stated that talks with Iranians are underway to potentially open trade routes and normalize the conflict. The Qatari Foreign Ministry even noted that a draft of a potential agreement is actively being circulated. Impartially speaking, the mere prospect of this deal entirely shifted market sentiment basically overnight. And this brilliantly illustrates the immediate market reaction. The price of crude oil fell dramatically. We saw a roughly 5.8% drop in West Texas Intermediate, pushing it way down to around $75 a barrel, while Brent crude slipped below $80. This significant cooling of oil prices helped erase immediate inflation concerns and fears of interest rate hikes, literally throwing absolute fuel on the fire of the broader stock market rally. All right, shifting gears globally for Section 4, India, earnings versus auction chaos. Right now, the Indian markets are experiencing a fascinating collision between spectacular corporate earnings and a highly confusing structural market change. On paper,
Indian corporate earnings have been incredibly strong. Telecom giant Bharti Airtel delivered a fantastic quarter, seeing their average revenue per user, or RPU, jump handsomely to 264. Meanwhile, ONGC delivered a blockbuster profit surge to 17,000 crores. This was massively aided by an incredible oil realization of $99.50 per barrel, totally blowing past street estimates. So the fundamentals are remarkably solid.
Yet, despite these strong fundamentals, if you look at the Indian markets right now, there is extreme confusion and volatility playing out right at the end of the trading day. So you have to ask, what exactly is happening at 3:15 p.m.? It all boils down to a new structural mechanic, the closing auction system, or CAS. Between 3:15 p.m. and 3:40 p.m., the market is essentially operating in a completely different reality. For example, in a recent session, the Nifty index unexpectedly jumped 150 points, which is a massive swing for that brief window, and the Bank Nifty surged a wild 400 points.
So, the crucial point here is that because traders are getting caught completely off guard by these wild swings, they're actively changing their behavior. Rather than participating, intraday traders are heavily squaring off their positions right at 3:15 p.m. before the auction even starts, just to avoid the volatility. It's essentially creating two separate markets and leading to a vicious cycle where a lack of liquidity in the auction is causing the exact poor price discovery the regulators were trying to prevent in the first place. Ultimately, it makes the market highly unpredictable and pretty dangerous for everyday retail investors just trying to find fair value.
Let's move to and see how this builds into our final segment, Section 5, the billionaire tax loophole. As markets hit these record highs and portfolios swell, the ultra-rich face a very different kind of problem, massive capital gains taxes. So how exactly do they navigate this? Enter the world's largest hedge fund, AQR, and a strategy that is essentially tax loss harvesting on steroids. It's a complex, highly mathematical strategy utilized by the 1% to ensure that while their wealth grows alongside the market, their tax bill effectively vanishes. Let's step through how they actually pull this off. It's like a giant puzzle. Let's say an investor puts $100 million into the strategy. The fund then goes out and borrows another $80 million against it. They take that capital and place massive long and short bets, broadly tracking the biggest companies in the indexes. Now, day to day, the market fluctuates, right? Some days certain bets drop. The exact moment a position drops, the fund sells it to realize the loss and instantly replaces it with a surrogate investment. So they are continuously, day in and day out, harvesting these tiny losses while tracking the broader upward trajectory of the entire market. And the math behind this over a long period is, frankly, jaw-dropping. According to AQR's own modeling, over a 10-year period, that initial $100 million investment could triple in value. But simultaneously, through that daily churn of selling the losers, the fund generates $587 million in capital losses. That is over $500 million in paper losses that the investor can now use to legally erase real capital gains in entirely different parts of their portfolio. No way, right? Which leaves us with a really fascinating final thought to wrap up this explainer. We've seen today how AI infrastructure, consumer behavior, and global geopolitics drive market growth. But when you look at the sophisticated strategies at the very top, you really have to ask, for the world's wealthiest investors, is beating the market really just about beating the tax man? It's a system where extreme wealth doesn't just benefit from the market's rise, but mathematically engineers a way to profit from its daily friction. Pretty wild to think about. Thank you so much for joining me, and keep questioning the numbers behind the news.